If, uh, if a malicious hacker locks down your company's servers today, they'll send you a message telling you exactly what your customer database is worth.
Oh, yeah. Down to the cent.
Right, like exactly what it's worth in Bitcoin, right down to the decimal point. But if you walk down the hall and ask your own chief financial officer that exact same question, like, what is the precise monetary value of the data sitting on our servers right now, they will almost certainly draw a blank.
Oh, completely. It really is the ultimate paradox of modern business. I mean, we are operating in this environment where every corporate leader openly acknowledges that data is their most valuable resource.
Yeah, you hear it all the time. Data is the new oil.
Exactly. Yet, if you look at their traditional financial frameworks, that asset is entirely invisible. Every office chair, every company vehicle, every laptop has a line item and a depreciating value on the ledger.
Right.
But the data inside those laptops, it functionally doesn't exist to the accounting department.
And that invisible gap is our mission for you today. Welcome to the Deep Dive. We're unpacking this incredibly dense, kind of paradigm-shifting concept developed by Naavi titled The Data Balance Sheet, Accounting for Digital Assets.
It's such a fascinating read.
It really is. And we're going to thoroughly dissect the mechanics of this idea so you can stay ahead of the curve. Because the core premise here isn't just a metaphor. Naavi is proposing a literal balance sheet for data, operating on the exact same principles as traditional financial accounting.
Right. A genuine, auditable ledger that tracks the specific monetary value of an organization's digital assets on any given day.
Which is wild to think about.
It is. To build that, you have to transition from thinking of data as this abstract, infinite cloud and start treating it as a hard, quantifiable entity.
Which brings us back to those hackers. Because before we can even start building a balance sheet, we have to agree on the fundamental mechanism of valuation. Like, how do we actually know data has tangible financial value?
Well, the proof is already out there.
Right. Okay, let's unpack this. Hackers basically act as the world's most aggressive, unsolicited data appraisers. They break in, run an analysis on what you hold, and set a market price via ransomware.
They absolutely do. And if you look closely at how ransomware demands are calculated, it is incredibly sophisticated.
That's not just a random number.
No, not at all. Bad actors don't just, pick a number out of a hat. They assess the volume of the data, the sensitivity of the personal information, and the immediate operational cost to the business if that data remains locked.
Wow.
They are performing a dark, mirror image version of a corporate valuation.
So we have bad actors on one side putting a hard price tag on these digital assets.
Yeah.
And on the flip side, you have legitimate data monetization models, right?
Yeah.
Like companies generating billions in revenue purely by analyzing and deploying customer behavior patterns.
Exactly. What's fascinating here is that both ends of the spectrum, the illicit market and the legitimate market, depend entirely on the intrinsic financial value of data. But sitting right in the middle is the traditional corporate accounting system, ignoring it entirely. The psychological shift required here is massive.
It really is.
If criminals and marketers both recognize the exact dollar value of a data set, a corporate balance sheet is fundamentally incomplete if it leaves that value out. It's just an inaccurate reflection of a company's true worth.
Okay, so the logic is sound.
Mm-hmm.
We know the value is there. But, logic doesn't usually change corporate behavior until the regulators get involved.
Sad, but true.
And looking at the landscape right now, the auditors are waking up to this exact problem.
They are, and it's moving from theoretical discussion straight into hard compliance. We are seeing a wave of regulatory movements demanding that organizations put a verifiable number on these invisible assets.
Let's unpack the alphabet soup of these new frameworks, because there are a few key acronyms you need to understand to see where this is heading. First, there's the DGPSI framework.
Right.
Now, for those tracking the acronyms, that is the Data Governance and Protection Standard of India. How does that framework actually force this valuation issue?
Well, unlike generic high-level cybersecurity guidelines, the DGPSI framework officially requires that data valuation be assessed as part of a formal audit.
Okay.
It creates a structured matrix. It demands that an organization look at the data they hold and calculate its worth, moving it from IT's responsibility into the realm of financial governance.
So it's no longer optional to simply say, like, hey, we have strong firewalls.
Exactly. You have to figure out what those firewalls are actually protecting in dollar terms.
And it's not just private compliance frameworks pushing this. The state machinery is stepping in. Look at the CAG, the Comptroller and Auditor General of India.
Yeah, this is a huge development.
They have explicitly instructed auditors of PSUs, which are public sector undertakings, so state-owned enterprises, to reflect a fair value of data assets in their audit reports.
That is a massive institutional signal. I mean, when the Controller and Auditor General mandates that public sector auditors find the fair value of data, it means the government recognizes that a state-owned enterprise's balance sheet is effectively fraudulent if it doesn't account for its data wealth.
It forces the issue right onto the ledger.
It does.
But wait, how does an auditor actually calculate fair value for an intangible gigabyte of customer records? Like a barrel of oil has a spot price, a ton of steel has a market rate. How do you standardize the value of a database so an auditor can sign off on it without just guessing?
That is the hardest part of the equation, without a doubt. And it's tied directly to legal frameworks like the DPDPA, the Digital Personal Data Protection Act.
Okay.
The value isn't just about what the data could sell for on the open market. It's calculated by looking at replacement cost, the revenue it actively generates, and, crucially, the legal risk it carries under privacy laws like the DPDPA.
So it's a mix of factors.
Yeah, you have to synthesize the legal, technical, and financial realities of that specific data.
Okay, so the CAG is demanding a fair value on these audits, and the DGPSI is requiring valuations. But if I'm a board member, I can't sit down and read a 500-page cyber audit detailing replacement costs and DPDPA compliance metrics.
No one has time for that.
Exactly. How is this actually reported to the people in charge? Which brings us to another acronym, the DTS, or Data Trust Score.
Right. The Data Trust Score is designed exactly for that boardroom problem. It's a core component of DGPSI-based audits. It serves as a single, unified indicator of the health of an organization's data protection compliance.
Wait, a single score? Isn't that dangerously reductive? You're taking this massive, incredibly complex web of cybersecurity protocols, legal frameworks, server logs, privacy policies, and potential DPDPA penalties, and distilling all of it down into one number.
It sounds crazy, right?
Yeah, how can a single indicator accurately reflect that reality?
Well, think about how the financial world uses a credit score.
Oh.
A credit score compresses decades of complex financial history, loan-to-value ratios, and payment habits into a single three-digit number. Is it reductive? Yes, intentionally so.
Oh.
The goal of a data trust score isn't to replace the 500-page IT audit. Its goal is to bridge the massive communication gap between the highly technical realities of the server room and the rapid decision-making required in the boardroom.
Oh, I see.
If an executive sees their data trust score drop by 50 points, they know immediately that their data assets are losing value or facing increased risk.
And they can direct resources to fix it without needing a computer science degree.
Exactly.
That makes perfect sense. It translates data health into a language business leaders already speak. So once you have these frameworks demanding evaluation and a score summarizing your compliance health, how do you actually map this out on paper?
This is the core of Naavi's thought experiment.
Right. Naavi introduces the concept of dividing data into assets and liabilities.
This is where the genius of the accounting approach really takes hold. In a traditional financial balance sheet, you don't just list what you own. You have to balance what you own against what you owe.
Yeah.
Naavi's framework argues that data does not exist in a vacuum. It's tied to real people, and possessing it comes with a heavy burden of responsibility.
Here's where it gets really interesting. The breakdown here is crucial. The assets are the benefits that flow to the data fiduciary, which is the organization holding and using the data.
Right.
But the liabilities are the obligations owed to the data principals, the actual people the data belongs to.
Precisely. If you are the fiduciary, you control the data, but you don't own it free and clear. You hold it in trust for the principal. And that trust creates a quantifiable liability.
Let's apply this. Instead of the old cliche that data is the new oil, let's look at it like raw uranium.
Oh, I like that.
It's incredibly powerful to possess. But if you don't invest heavily in containing it, it becomes a toxic liability. Imagine you run a massive e-commerce store. Over the years, you've collected a colossal list of customer buying habits, addresses, and credit card preferences.
Okay, so let's build the balance sheet for that e-commerce store. On the asset side of the ledger, you have the predictive analytics you run on that data.
Right.
You can target ads perfectly, predict inventory trends before they happen, and boost your revenue. You can calculate the exact historical ROI of that targeting. That is a hard asset.
Right. But then we look at the liability column. To hold that raw uranium, I have to build a massive cybersecurity infrastructure to protect it from hackers.
Yep.
I have strict legal obligations under laws like the DPDPA not to leak it. If I do leak it, I face catastrophic fines and class action lawsuits.
And that is exactly how you quantify the liability. It's not just the operational cost of the firewall.
Right.
An auditor calculating the liability side of your data balance sheet will look at the probability of a breach, multiplied by the potential DPDPA fines, plus the projected cost of reputational damage.
Wow.
Suddenly, holding a petabyte of customer data isn't just pure profit. Every byte of data you collect inherently increases your liability column.
And this completely flips the script on how tech companies have operated for the last 20 years.
It really does.
The dominant strategy has always been to hoard as much data as humanly possible. Gather everything, keep it forever, figure out how to monetize it later. But we view data as a dual-edged sword. Hoarding data isn't just gathering free money. It's actively taking on debt in the form of risk and legal obligation.
If we connect this to the bigger picture, it is a profound shift. And this entirely builds on Naavi's overarching theory of data, which argues that digital information must be treated as an entity with integrated economic, legal, and risk dimensions.
They're all connected.
Right. The balance sheet is simply the practical, mathematical application of that theory. But, as with any advanced accounting practice, the real world introduces complexities that go beyond simple assets and liabilities.
Which brings us to what might be the most counterintuitive part of this entire framework, the contra conundrum.
Yes, the contra items.
So what does this all mean? We understand that the fiduciary holds the assets, and they owe the principals the liabilities. But what happens when you bring a third party into the mix to actually do the work?
This is a highly specific, very technical accounting question that Naavi is raising. When an organization uses a data processor, does that processor function as a liability, or does it function as a contra item on the balance sheet?
I have to admit, I genuinely wrestled with the accounting terminology here when looking at this.
It's dense stuff.
Yeah, I understand the concept of a data processor. If I run that e-commerce store, my processor is the cloud server I rent from Amazon, or the third-party marketing firm I hire to crunch the customer analytics for me. But what exactly is a contra item in this context? Like, is a data processor a negative asset? How does handing data to a processor create a contra account?
It's a phenomenal question, and it really cuts to the core of how nuanced digital accounting needs to become. Let's look at traditional finance first.
Okay.
A contra asset account carries a balance that is opposite to the normal balance of its related asset account. The easiest example is accumulated depreciation on a piece of heavy machinery.
Right, like wear and tear.
Exactly. You buy a factory press for $1 million, but every year you use it, you record a contra asset to reflect the wear and tear. It mathematically reduces the net value of the machine on your books.
Okay, so the asset's gross value stays the same, but the contra item drags the net value down over time.
Exactly. Now, apply that mechanism to data. Naavi is asking us to consider if handing your data to a processor acts like a contra item. Suppose your pristine, internally controlled customer database is valued at $1 million on your asset column, but you can't process it yourself, so you hand it over to a third-party marketing firm. The moment that data leaves your internal servers, do you have to record a contra asset to reflect the loss of absolute control?
Because the moment someone else holds it, my risk profile inherently changes.
Precisely. You have increased the surface area for a potential breach on their end. Furthermore, you have contractual costs to pay for their service.
Right.
So does that external risk offset the pure value of the asset? Does handing it to a processor effectively depreciate the net value of your data?
Or, on the flip side of the debate, do you just list the processor straight under the liabilities column because they represent a direct external risk to the obligation you owe the data principal?
Exactly.
That is incredibly deep. We're debating whether the very act of utilizing the data through a vendor mathematically reduces its net value on the balance sheet because of the shared risk involved.
It's a whole new way of thinking about vendor risk.
When you map it out like that, it makes perfect sense why a generic, one-size-fits-all accounting standard isn't going to work.
It absolutely won't work. The mathematical weight of a liability or the risk depreciation of a contra item changes wildly depending on the context of the data.
Which is why Naavi is currently working on specialized DGPSI versions tailored for specific, highly regulated industries.
Exactly. Namely, healthcare BFSI, which covers banking, financial services, and insurance, and the education sector.
Let's dig into why those three specifically need their own customized balance sheets. The liability side for those sectors would look fundamentally different from my hypothetical e-commerce store, right?
Entirely different. Let's look at healthcare and BFSI. They handle the most sensitive, highly targeted data on the planet.
Oh, yeah?
Deep financial histories, credit profiles, medical records, diagnoses. The obligations to the data principals in a hospital are not just about preventing targeted ads. They are literally life and death, both medically and in terms of devastating blackmail potential.
So the way a liability is calculated for an MRI scan or a psychiatric evaluation has to carry a massive risk multiplier compared to a database of shoe sizes.
Exactly. And consider the education sector. You are dealing primarily with the data of minors.
Right. That changes everything.
The legal liabilities associated with the data breach involving children are exponentially higher under almost every global privacy law. A leaked student profile could result in long-term identity theft that isn't discovered until the child turns 18.
Wow. So the tail on that liability is decades long.
Yes.
Which means how a third-party processor is accounted for in a school district versus a bank versus a hospital has to be weighted completely differently. The math changes.
It has to be developed sector by sector. You have to design the ledger to account for the unique regulatory and ethical weight of the specific data being held. Naavi's specialized frameworks are trying to capture that nuance so the balance sheets actually reflect reality.
It is a massive undertaking. When you step back and look at the entire journey of this concept, we have moved from the grim reality of hackers appraising our data with ransomware through the regulatory push of the CAG and DGPSI frameworks demanding fair value, to the DTS compressing that compliance into a boardroom-ready score.
And finally, arriving at the mechanics of the balance sheet itself, mapping out the exact financial relationship between the fiduciary's assets, the principal's liabilities, and the risk depreciation of third-party contra items.
Whether you are preparing for a strategic boardroom meeting tomorrow, or you're simply curious about how the underlying architecture of the digital economy is shifting, understanding this transition is vital.
It really is.
We are moving away from the era of data as an infinite consequence-free resource into the era of data as a hard, auditable ledger item. Fully grasping that accounting shift gives you a massive competitive advantage.
And if we follow the logic of that shift to its ultimate conclusion, it leaves us with one incredibly provocative implication to ponder.
Ooh, okay. What is it?
If Naavi's concept of assigning a notional value to data becomes a globally recognized, legally binding accounting standard,
Right.
what happens when governments inevitably decide to start taxing organizations based on the exact value of their data assets?
Wait, really? Oh, wow. That completely changes the incentive structure of the entire internet.
Doesn't it?
Mhm.
If your data is a taxed asset, would companies suddenly flip their entire corporate strategy?
I mean, they'd have to.
We might see a world where organizations actually try to prove to their auditors that their data is worth less. Instead of the current model of hoarding every single byte of user behavior just in case it is useful later, companies might frantically initiate mass deletion protocols just to avoid a crippling tax liability at the end of the fiscal year.
The ultimate irony. The moment we figure out exactly how much the data is worth, it becomes too expensive to keep.
Yeah.
That is a brilliant thought experiment to leave you with today. If the asset becomes a tax burden, the entire digital economy has to rewrite its playbook. Thank you for joining us on this deep dive into Naavi's framework. Keep digging into the mechanics of these sources, keep questioning how the ledgers are built, and we will catch you next time.